Well, hello, everyone. My name's Leslie Lundeen. There it is. I'm with LBG Real Estate Companies, and I'm going to be moderating the next panel. Now, we have to apparently get back on schedule, and I'm going to try to have questions at the end, but we only have about 50 minutes, and we have a huge topic that we have to cover. We're going to be covering basically all the different flavors of crowdfunding. And I wanted to try to do a real quick demographic survey, but half the crowd is outside, but with whoever's here. So who here actually has participated actively in crowdfunding in the past? Okay, and so your sponsors, you've raised money through the crowd? Okay, and who is interested as a sponsor in raising money through the crowd? Okay, so more, the majority. So you're interested and you're trying to figure out which way to go because it's really confusing, which it is. And, you know, I was going to do a legal disclaimer at the beginning of this, but I think that whole last panel was a big legal disclaimer. So I'm going to, which was a great panel. It was a great panel, but there were a lot of warnings there, and it could scare you away, and I don't want you to be scared away. So, because I think I've raised money through the crowd, and I really thought it was a good process, and it's definitely still in its infancy, and I did it 18 months ago, and it's still in its infancy, but I think, you know, we're all going to talk about our experience with crowdfunding and try to help you out and have some time to answer questions at the end. So again, my name is Leslie Lundeen. I'm with LBG Real Estate Companies. We're an owner-operator of shopping centers. We basically buy shopping centers, do value-add plays, mainly in the Western U.S., and our typical equity check is about $5 to $10 million, which is a little big for the crowd, but we're going to talk about sizes. And I'm just going to go down the line and have all the panelists do a quick introduction and just talk briefly, because we don't have a lot of time, about your experience with the crowd. And then we're going to get into pricing and structure and that sort of thing. So, Greg?
So I'm probably a little bit different on the panel. My name is Greg Hebner. I'm a partner managing director in Arixa Capital, which is one of the largest specialty lenders here in California, primarily focused on residential construction. My background also is I've been a developer of single-family residential properties. I've done about 250 projects where we've purchased, renovated, torn down, or rebuilt homes, mostly in coastal California. We basically manage a number of commingled, feels kind of old school among this audience, old school real estate funds, all accredited investors, hundreds of investors who have sort of $100,000 to $200,000 minimum investments as opposed to some of the numbers we heard. And we primarily are making first trustee debt investments to professional real estate investors who are mostly doing this as a profession. So I come from a technology background. I was the CEO and ran a number of technology companies until the housing crisis. And now I kind of feel like technology has moved ahead of me a little bit, and a lot of things are happening quite different. We have a lot of borrowers who use the crowd for the mezz and the junior, the equity behind our deals. So there's definitely, we see that on a number of deals. We've looked at a lot of the term sheets as it relates to some of the platforms who sat behind our debt. But we probably provide a very similar product to what Jason would provide, and so we're probably more competitive with some of the crowdfunding platforms in terms of, I could probably provide a little bit of a sense of what maybe our borrowers are seeing versus using the crowd, because we're still, I think we're I'd call it kind of old-fashioned crowd. It's still a lot of individual people, and we're still matching it up with individual borrowers and individual investments. But we probably haven't embraced maybe the same level of technology and things that some of our other panelists have. But we are certainly seeing more and more activity from our clients who, especially on the equity side, are very attracted to the access to capital and the ability to really bring down their cost of funds.
Okay. Thanks, Greg.
Hi, everybody. My name is Jason Fritton. I'm the executive chairman and co-founder of Patch of Land. We are an alternative marketplace lender and crowdfunding company that specializes in what we consider to be the bones of real estate. The fix and flip on single-family residential, small multifamily, mid-sized multifamily. We've since been expanding out into some more of the smaller cash-flowing commercial opportunities, but realistically, that's not our particular specialty. We've got a crowd of about 20,000 registered accredited, of which about 15% are active. Our crowd, on average, will do about 12 investments with us on per year. And our borrowers were generally borrowed 2 to 3 times per year apiece. So we're active in about 46 states now. There's 4 that we're really not active in because of licensing and registration. My particular experience with is like Greg in tech. I came from a tech background. I worked a lot with the government and military. I built a $30 million a year company from there and lost it overnight in the financial collapse. And I really started Patch simply because I saw that this is the direction that finance is really taking, to be able to coordinate and aggregate the experiential skill sets and the resources of a huge amount of previously unrelated people and be able to focus them on something that would normally be very difficult for an individual person to do. And we've had a great deal of success with that.
Hi, I'm Julian Hellman, and I'm the CEO of RealtyMogul.com, and we're the largest crowdfunding platform for commercial real estate. We've got over 80,000 investors. We've invested north of $200 million in capital raised from the crowd. And we focus exclusively on commercial real estate. So the majority of what we do is the big food groups: apartment, office, retail, industrial. We've also done some work in self-storage and mobile home parks as well. And we have 4 key products. We have 2 debt products and 2 equity products. Our debt products are senior debt, which is a bridge loan, mezzanine debt, so we'll sit behind a first lender, usually a bank or an insurance company. We don't sit behind CMBS very often. And then on the equity side of the business, we have a preferred equity product where we will finance up to 85% of the capital stack. And we have a joint venture equity product where we will finance up to 90% of the capital stack.
So my name is Jonathan Chang. I'm the Director of Investments at Pacific Castle. We're owner-operators. We have about $1 billion AUM under management right now. So we've used crowdfunding twice, I think, on 2 different deals, one recently. And we have, the equity that we get is, we actually go through a pretty wide spectrum. We have active JVs with Prudential, PREI, Inland, and a couple of different big equity shops, and then you run your gamut of obviously family offices, high net worth individuals. But we only focus on retail, so we only buy shopping centers. Our assets are all along, up and down the West Coast, anywhere from a $10 million asset up to $150 million, give or take.
Okay, so Jonathan and I, we're kind of similar, right? We both raise money through the crowd. And then you have your crowds already, and you have capital that you're putting out. So just so you understand where we are in the spectrum. Now, if you're a sponsor, and let's say you want to raise, $2-3 million in the crowd, you're going to have choices, right? You could go to Jillian, and you could say, Jillian has already potentially pooled the money, and she could just write a check. Or you could do kind of what I did, which is we went to a platform, and it's basically their marketing for us, and they just expanded. We went to Real Crowd, and they basically just expanded our network, but I controlled the money, the escrow, the escrow was controlled by me. Nobody touched the money except me, like a typical syndication. So there's different ways you could do it. You could also do white label, where, and I don't know if you want to, Jonathan, talk about your experience as well. You could do a white label where you could pay one of the platforms to basically put a plug-in on your own website, or that goes to their website, and you could use your own network, but just effectively use the internet. Did I miss anything? Other ways of doing it? So we chose to go with a Real Crowd type platform for ours because I am a control freak, and I was a lender for 20 years, and I want to make sure that I control the money and I control the message. We also have experience with institutional investors, fund partners, and our own syndication network, and we wanted to get away from having one partner. Therefore, we didn't choose a platform which would effectively write a check, which was obviously more cumbersome. Jonathan, where did you end up doing?
Yeah, so we've done, I think it's 2 or 3 deals, I can't remember anymore, but we've done them all with Realty Shares. We looked at Realty Mogul and all the other platforms as well. One deal we purchased about 2 years ago, I think they raised, it was like $300,000. So for us, for our company in particular, we do have quite a few different sources of equity we can go to. So to be frank, crowdfunding doesn't play a huge role in how we raise equity. For us, it's more kind of a supplementation and kind of time. It saves us time, essentially. if someone can come in with, you know, $250,000, $500,000, or $1 million check on these smaller deals we buy sometimes, it frankly just saves us a couple of phone calls to make to the investors. So for us, you know, with Realty Shares, when we did it, they basically they go to their investors, they form the single purpose vehicle, and they invest via their LLC, which is preferably, I know it's different than how Leslie did it. For us, it just makes more sense to do it that way because frankly, we don't want 25 investors coming in at $25,000 each or something like that, where we have to, it's kind of brain damage for us to cut all the checks, and you know, frankly, they're the ones going to be asking more questions on a day-to-day basis, which we're happy to answer, but it just takes away from what we're truly trying to do, which is buying properties for the investors and maintaining the properties and kind of building their equity line instead of answering questions all the time. So we just did a deal with Realty Shares again out in Salt Lake City in Utah. I think they raised $500,000. We've only had the property for about 8 months. I think we just did a reprojection on what we're planning to do with the center. So I think the IRR standing right now, we're projecting like a 40+% IRR return for the investors. So for us, crowdfunding plays a small piece in it. You know, I'm not sure where it's going to be 5 years down the line, because we've had this conversation about 2 years ago on a different platform. It seems like it's gone a little bit better where they can raise a little bit more money. But as far as if you're looking for a $10 million equity check, you know, of just straight investors who can fit your profile on an investment, I'm not sure it's going to be there. It might be in the future if they open up all the regulations and stuff, but as of right now, it's probably not doable. I think the cap is, and you guys can probably answer this better than I can,
Yeah.
probably like $1 million, $2 million is kind of where everyone sits.
Not on our platform. I'm actually interested to hear the small dollars that were raised. We actually won't do a raise under $1 million. So we wouldn't do a $300,000 raise or a $500,000 raise. On average, our raises are running about $3.5 million. So our sweet spot is $1 to $5 million when we fund JV equity, but we just won't do anything as small as $300K or $500K. We can't make any money on it, frankly, right? There's some point where as a company you have to decide what you're going to focus on. And we've seen great success in that. You know, one of the limitations that I think you have when you structure in special purpose entities is that you're limited to 100 investors. And one of the things that we've focused on in our accredited investor business is finding wealthier investors. So our average investment from an accredited investor is $101,000, which gives you, I think, a lot more scale than maybe the experience that you had with another platform that has, you know, smaller investment sizes and is writing smaller overall checks.
Sure.
Yeah, we're similar in that we have a bigger range. We'll go all the way down to 100,000, but we're completely on the debt side. The largest deal that we've done is $14.5 million. But to be honest, that didn't go to the crowd. That went to one of our institutional partners. The largest deal we funded through the crowd was $4 million. But our sweet spot tends to be in that $1 to $2 million range at this point too. It's definitely grown over the years. Our first deal was $140,000 the first year. Our average size was sub 200,000. Second year, the average size was 600,000. And we're really looking north of $1 million on average sizes this year. We can reliably raise at this point, just from the crowd alone, $3 to $4 million relatively easily.
Yeah, you know, one other just comment on that. We actually have a sponsors in the room today who's one of our good clients, and we're close to doing about $15 million for them. We have another client who we've done about $10 million in transaction volume for as well. So I think the numbers are going up, right? 2 years ago, I couldn't have said that. 2 years ago, I would have said, you know, we did 2 million or 1 million. But I think you know, we see on a monthly basis, we're adding thousands of net new investors. And it goes back to the point earlier in the earlier panel around the entire population doesn't even know the term crowdfunding yet. So there's still a big educational challenge. But as more and more people learn about the concept and sign up and start sort of poking around these platforms, I think the deal sizes are going to continue to go up.
Yeah, it's definitely a huge untapped market. Now, just kind of cutting to the meat of it, how long is it going to take to raise the money, and how much is it going to cost? Because we've been seeing, just my experience, I've been seeing the pricing going down, which is nice, and you can raise it very quickly. But as something was mentioned in the earlier panel, we haven't done crowdfunding for acquisitions. We've reverse syndicated because of confidentiality issues, and we don't like blasting our deals out to the market. So,
Well, on our side, we're a little bit of a hybrid. We use internal capital to pre-fund
So
our
you're
deals.
doing what we've
so
done.
we'll vet the deal, and then if it meets our credit guidelines, we'll fund immediately. Our average time to funding is about 7 business days
Okay.
at this point. We usually then immediately launch that to the crowd or to one of our institutional partners, and then it's usually off our books within about 24 hours.
And just so people understand the types of deals, obviously there's a wide spectrum of deals. It could be a construction deal, it could be you're buying a vacant box and you're re-tenanting it, but you don't have your tenant in tow, or it could be just a nice cash flowing deals. So in my experience, the crowd prefers cash flow. That's the best way. How do you get deals done along the spectrum, and what do they cost? Because we don't have a ton of time, so if you could just kind of bullet point.
Sure. So, on our fix and flip deals, we operate under traditional lender mechanics, where we've got a coupon that goes out to a rate to the sponsor. That generally ranges on our deals anywhere from about 9% up to the very high end to about 14%. Patch is a portal that sees a servicing strip of that, and then there's lender origination, which are paid up front at time of closing, depending upon the deal, depending upon the risk profile, depending upon the asset and the borrower. We're looking anywhere from between 0.5 point to 4 points on that at the very high end. And then on the cash flowing deals, the ones that are debt servicing, so we offer now our midterm product for stabilized properties that have renters in place that are debt servicing. That ranges anywhere from 6.99 as far as a rate's concerned up to, at the high end, about 9. Again, points are a range on top of that.
And that's the total coupon, so there's no look-back IRR.
No.
That's current pay.
Correct.
So it's 9% for what? How much of the capital stack?
So we'll actually fund up to about 90% LTC on the stabilized properties. We don't like to go that high. Our biggest indicator of success for a borrower is to make sure they have skin in the game. So we'll go up to generally about 80, but we will go to 90 if the deal specifics make sense.
Okay. And will you do kind of mezz pref equity?
No, we
Structure?
really don't
Okay, so
work
that's
on
for
that side.
that's for all the capital.
We're pretty standardized in what we do. We want to make sure that we're able to be a volume player. And we've got very, very specific offerings that we're working to scale.
Okay. Jillian, what do your structures look like?
Yeah, so we have 4 products. First product is senior debt. It's a point origination. So we're just like most other senior debt lenders. We're typically priced in the 6 to 9% range. So we're really focused on more bridgey value add kind of debt. We're not competing with your local bank. We're not competing with your local CMBS lender. On our next product, which is mezzanine debt, we charge 2 points, so 2 points origination. And our mezzanine is typically going to be priced in kind of the 9 to 11% range. And we're going to go up to 80% LTC on our mezz product. Going up the capital stack, you have preferred equity. We're usually 2 points in, 1 point out on preferred equity. It's going to be a little bit more expensive. You're going to be in kind of the 10 to 12 or 10 to 13% range. That's going to go up to 85% of transaction. And then the most expensive and the most risky piece of the capital stack is going to be joint venture equity. That's going to be 4 points, and we're going to go up to 90% of the equity. Although the fee on the joint venture equity is a deal cost. So the same way that you're going to capitalize your lender costs if you're raising equity for a transaction, you're going to capitalize that cost in the deal. So there's no out-of-pocket cost there. Really, the investors are bearing, a substantial piece of that cost. So for example, if we're 90% of the equity in a transaction, 90% of that fee is actually going to be paid by the capital that we're raising, right? The sponsor, if they have their own capital in the deal, is going to pay about 10% of that, or 40 basis points of a 4% fee. Make sense?
Greg, how does that compare to what you can?
Yeah, so we're usually going to be 75 to 80% of acquisition cost, and then we probably do renovation and construction components to our loans, probably 2/3 of the time. So we like the construction draws and allowing the borrower to pull that money out as they need it. We're mostly in California, which is the most competitive state for private lending, as you know, Jason. So I haven't seen an 11 or 12% rate in 2 or 3 years. So our rate's going to be somewhere in the 8s, topping out at about 10%. We are very flexible with term, so we'll do short durations, 3 months or less if it's a very quick bridge, up to 18-month loans, and we price the origination points based on the time you need the money. So somewhere between 1 and probably 3 points is a good guide. We've done a little bit of mezz recently, usually behind very particular lenders who we've got a good relationship with. That might take us up to 85 or 90% of the cap stack with very, very sophisticated and experienced operators. That's probably going to be similar rates here, is what Jillian was saying, probably 12, 13%, similar points. We earn the points primarily as the, we manage commingled funds for our investors. Our investors get a piece of the points, we take a piece of the points, and then most of that coupon goes to our investors. We run funds with 8 and 10% preferred type of returns for our investors.
Okay, so let's say I don't have the money, I do, but let's say I don't have the money to close with my own cash and reverse syndicate, which most people don't. So what is the execution risk going with a crowdfunding platform versus a traditional equity source where someone can just write a check? Jillian?
Yeah, we've done north of 200 transactions. There was one that we didn't close. So
And how long?
Pretty good
When do
statistics,
people-
and the one was like we were 4 months in business, so I counted against us, but we didn't have a database, right? And I'd say 95% of our sponsors don't have the ability to close themselves. 95% of our business is acquisitions. Start to finish, our process is about 40 days. And again, we're strictly doing commercial real estate financing, so no residential, none of the fast sort of fix and flip stuff. We do a lot of diligence, right? We behave in the diligence like a traditional private equity real estate firm. And I think that the easiest way to get comfortable is to look at the track record of a platform, right? We're never going to tell a client we think we're going to be successful in your transaction unless we genuinely think we're going to be successful in their transaction. We also have a $35 million balance sheet, so we can back transactions with our own balance sheet. We never do, guaranteed funding until obviously we've done all of our underwriting and all of our due diligence, and that takes time, right? If we're equity, we're typically running in parallel with the senior lender. We're waiting on an appraisal. We're waiting on environmental. Just like any other joint venture equity partner, we're not going to give the sign off until we've actually finished underwriting. And in the nature of real estate, that doesn't happen. It's all in a crunch, right? But we know up front where we think the underwriting is going to come out, and then we use all of the third parties really in confirmatory underwriting, just making sure that nothing comes up that's a surprise.
Okay, so you're really acting like a traditional capital source, basically.
Yeah,
And I
the
think
difference is that we raise our
that's-
capital on the internet.
Yeah, but I think that's a little unusual for the crowd platforms. The platform I used, basically, we put it out there. We raised the money very quickly. We raised it within a week, but it was less than $1 million. So, but we took the risk. So if we couldn't raise the money, then it was on us. Whereas I think there's probably a lot more security when you go with a group that is acting more like a fund source.
In our world, Jason, you know this, our borrowers don't have 40 days and they have to go hard on their deposits. So we've never not funded a deal. And I think the strength and one of the reasons we're able to maybe charge what we charge is that we can move as you do. It might be 3, 5, 7, 9 days. Our borrowers need quick decisions. There's no way these borrowers could close these acquisitions without us as a partner, and the banks can't move fast enough. So I think that's really the reputation of what we have is there's never been a deal we haven't funded, and we have just under a $200 million balance sheet capacity. So our typical investment's about $1 million. So we have access to banks, we have our own capital. And we have an ability to raise more capital should we need to, but we're able to use our own balance sheet to be able to fund our investments.
Okay. And, I think we have to do questions in about 5 minutes. I'm going to get to your questions. But quickly, how do senior lenders feel about crowdsourced equity? Because I know I have that question. We actually did a CMBS loan. And we had to do the crowdfunding after we closed the CMBS a certain time after, because the CMBS market really didn't like the idea of widely advertising the deal. Now, again, this was like 18 months ago, so maybe they're more used to it, but it is something to think about when, disclosing your equity source, because lenders kind of like to know where the equity is coming from. What experience have you had, Jonathan?
Yeah, I think for us, I don't think lenders, frankly, care for that. I mean, they're not for it or against it. I think as long as you can prove that they are accredited, there's no issues there. It hasn't been an issue for us. And obviously ours is a little bit different because ours is coming in as an SPV into it, so you can't really penetrate into what the LLC of the SPV, what investors are in there. So all they really see when in the structure, when they see it, is they see $500,000, $1 million investment, whatever it is. So to them, it's just an entity that's investing in it. So for us, I don't think lenders have ever caused an issue. To go back to the money you guys raised, the one thing I would say, I think as sponsors, we're always looking for the cheapest equity, right? Debt, to be frank, is a commodity at this point. Anyone can get debt with a pulse, pretty much. You're looking for the equity that's going to fit your structure. For us, we try to keep the equity costs very low. To give you an idea, like we have a JV with Inland. It's obviously a big REIT. As you guys can imagine, the REITs, they charge an arm and a leg for their capital. I mean, some of their costs from some of the subscriptions agreements we've seen to go up to 14 to 16% on cost of capital. So I mean, you're walking into a deal, if you don't push the rents up, you're not going to make money at that point. So for us, yeah, I think raising $2 to $3 million is pretty impressive, to be frank. The thing is, for us, the cost of capital for us at that point is too high on that kind of stuff. So we're not looking for something, just to be frank, I mean, our company doesn't put any mezz debt on anything, and our LTV usually never crosses 65 LTV. So for us to get to, the high teen returns that a lot of people are looking for in this market today, you have to push the LTV up to like 85 or 80+%. And that's the only way to do it. And at that point, we're going to see, I mean, knock on wood, a deal's going to go bad on one of these platforms, and we're going to have to see what happens at that point. Where does the crowd follow in that point, and see what happens in the downturn. Because right now, I mean, if you invested, I think we were just talking about earlier, if you invested anything in the last 3 years, if you didn't make money, you don't know what the heck you're doing, just to be frank.
Okay, so quickly, I just want to go down the line, and nobody can repeat what the last person said. Biggest advantage and disadvantage of crowdfunding. Jonathan, we'll start with you. I'll go last.
Yeah, I think
no repetition.
Yeah, the advantage is saving time, obviously. I mean, especially if someone is going out to raise the capital for you via the crowd. I think the biggest disadvantage is if it doesn't happen, if you're counting on the money and it doesn't happen, what do you do then? Especially if you don't have a credit line to close a deal or something.
Yeah, I think the biggest advantage for sponsors in particular, maybe just because there's a lot of sponsors in the room, is you get to focus on what you're really good at and why you started your companies, right? I imagine you started your companies because you love real estate, you love acquiring real estate, you love operating real estate. You may not love country club dinners 5 nights a week, right? And so we're specialists in raising capital. We're not specialists necessarily in operating, your retail shopping center. And so by outsourcing your capital markets to a crowdfunding platform, you can focus on presumably what you love and what you're really, really good at. I think the disadvantage is that you are relying on the underlying investors of that platform, and those investors really have an allegiance to that platform, right? Our investors are investing multiple times on our platform across a number of different sponsors, so they're not strictly your investors, right? But if you think about collaborative consumption and shared resources and 1 + 1 = 3 when you're sharing people, I view that as a positive, but some could view it as a negative that you don't have a direct relationship with that investor.
On my side, I think the biggest advantage of crowdfunding is the flexibility that it affords you. We have a traditional East Coast fund. They've granted us about $250 million, but they've got a credit box that's like this. I've got thousands and thousands of active, highly sophisticated, accredited investors on the platform that have a credit box like this. So there's different degrees of risk appetite, there's different degrees of sophistication, there's different degrees of value that they're placing on each individual project. So we have the ability to get deals done that would be outside of a very narrow box that some of the, that maybe Wall Street may dictate, but that are still good deals nonetheless. And we do all of our underwriting, so we're not going to put crap up on the page. The biggest disadvantage I can see realistically, for crowdfunding, one of the biggest disadvantages is your credibility risk. You're putting things out online and bringing it out to thousands or hundreds of thousands or millions of people over the internet. If you don't perform, things become public. So you have to keep that in mind.
I think the biggest advantage is simply being able to expose as a successful operator what you do and your individual investments to a brand new audience. So when I started my development, I had 50 investors. All of them I'd met with. It wasn't country club, but it was friends, introductions. Raising that capital, it would have been nice to put out deals and not had to do that. I spent an enormous amount of time building that. Now that I've built it, it's a great asset, but could have done a lot more deals if I didn't have to do that. So having that exposure, I think, is fantastic. I think the biggest disadvantage, and I've seen this happen again and again, I think every platform's different, is things don't always work out exactly the way you want them to work out with. I've probably refinanced 5 or 6 loans this year that were 12-month loans on various crowdfunding platforms that couldn't get extensions or couldn't get reasonable extensions. San Francisco deal where the city slowed up a permit, and next thing they knew, they needed another 6 to 9 months. On the crowd, I don't know how that happens. I think every platform handles it different. With me, they talk to me or one of my origination team, and we go through the situation, we re-underwrite it, and we give them an extension if we need to give them an extension. Having a person to talk to and being able to work things out, it's been a great real estate market the last few years, as you were saying, Jonathan. Really, really hard as a debt lender to lose money unless you make a big, big mistake. Next 5 years may be very different. There's going to be workouts, there's going to be bad loans. I just don't know how the individual platforms, I know you're all thinking about it, I don't know how that's going to work for the sponsor. They're going to need a helping hand, they're going to need maybe a little flexibility. I just don't know if it involves hundreds of investors, what's that going to entail.
Okay, I'm going to go global here. I think potentially the ability to disrupt the capital markets, crowdfunding could get other capital sources to become more flexible and cheaper. Hence, you could do a crowdfunding deal, or you could do a traditional fund deal and say, well, I could go and I could get the money for the crowd for 9%, or I could get it for you. So it will ultimately, because it's bringing more capital to the markets in general, and this isn't necessarily happening this year, but 5 or 10 years from now, it could basically create a broader market and make commercial real estate capital cheaper, which I think it should be in general. So that's a huge advantage. Disadvantage for anybody that gets involved in an industry in its infancy, and a Madoff event does occur, we could all get swept away with it. So that could be a kind of a scary thing. But you got to do business. So, okay, I'm going to open it up to questions now. Anybody have any questions? Yes.
Julian, I'm curious how you deal with a situation where, let's say that you had to step into the shoes of the sponsor as the pref equity, service the debt. Do you step into the carve-outs? How does that, the lender carve-outs?
It depends on the deal, right? We have certain transactions where in our pref equity documents, if there's a changeover event, we have to sell the asset, right? So the decision is that we sell the asset and we look to get the lender out first, obviously. There are other legal documentation, it really depends on the lender, right? Is it behind CMBS debt? Is it behind life company? Is it behind bank? There are some situations where we would have to if we take on that liability, right? So we'd have a choice in a changeover event to take on the liability to say, either we're going to put the asset up for sale in the next 6 months or 8 months, or we're not going to put up the asset up for sale. We're going to step into the shoes of the sponsor, and we're going to take on a piece of that liability. So it's really on a situation-by-situation basis. And it depends on the lender, right? It's the flexibility of the lender. Obviously, we go in with stock documents. Some lenders, like regional banks, you can usually get pretty good docs. CMBS, you're not going to get good docs, right? It's going to be your generic docs. Fannie and Freddie, if you're doing pref behind Fannie and Freddie, they have standard soft pref equity documents. They're really not negotiable, right? They're slated in the market, and they've been used for a long period of time. So documents really depend on the senior.
Do you not get yourself approved as a replacement guarantor?
In many situations, we do. In every situation, we can't.
I mean, prior to anything happening.
Yeah. In many situations, we do. But again, it depends on the senior lender.
Okay. Any other questions? Oh, in the back. Okay.
For those of you that have institutional funding sources as well as crowdfunding sources, how do you allocate the deals amongst those different parties and avoid discussions around cherry picking or favoritism?
Yeah, that's a good question. Well, dollar size, equity size is a big part of it for us. And we've only used the crowd once because of the check size and because we only reverse syndicate. So if you don't want to put $10 million of your own cash in to close, and you don't want to advertise your deal, then you typically can't go to the crowd. So you have to have institutional capital partners. Or what we do is we actually have one individual that writes a preferred equity check, and then we put the rest of the cash in. And then you could potentially reverse syndicate afterwards, part of the equity. So for us, it typically doesn't work. It has to do with dollar size. So.
Yeah, credit box differences, but where there's overlap, it's one of our biggest challenges, honestly. Our crowd wants to make sure that we're not cherry picking to give to Wall Street and vice versa. Right? It's been a significant concern. It's going to continue to be a significant concern as we grow from doing 20 million a month to 50 million to 100 million a month. Realistically, right now, we do our best to operate on a round robin basis when we have overlap between the two credit boxes. Now, as I mentioned before, our institutional partners tend to have much more narrow credit boxes. That's why I mentioned in certain cases we try and stay right around 80% LTC, but in certain cases we can go up to 90 if there are mitigating circumstances and so on. There's no way my institutional partners can be able to take that, but I do have a set group of retail investors that would love that particular deal, in which case it's an easy decision there. But when we have relatively the same type of credit box, we'll try and move it around robin, but overall we'll try and saturate the appetites. My institution will take 20 million a month from us. My crowd right now at most, is quite honestly probably about 15 million a month is what I can do right now. It's been growing significantly, but if I already given my crowd 15 million a month and we have additional demand or supply that's in that particular credit box, then we'll allocate that to the institution.
Yes.
Do any of your platforms work on tax credit pass-throughs, low income, new market tax credits, historic tax credits, renewables, when you work through deals?
I haven't seen it.
Yeah, we've done some stuff like that. We're working on a deal actually actually I can't mention it because it's a 506B, but we're working on a deal that's got some tax credit stuff with it right now. And then there's also depreciation, right? So when you think about, one of the benefits of structuring in an SPE is that we can do pass-through depreciation for our investors. And we negotiate that. So we'll negotiate, typically pari passu depreciation that we can use as a write-down on the K1s that we send out to our investors. When you have wealthy investors, it's really meaningful, right, if they have current income. But yeah, we've done some tax credit stuff. We've also done a number of transactions where there's rent control, both in New York City and here in Los Angeles. And there's advantages and disadvantages to that. Obviously, you're underwriting sort of a different level of risk. We have a New York office who's done a lot of work around particularly the legislation in New York, and obviously we're very familiar here locally in Los Angeles, being here and sort of being engrossed in the real estate business here. But we absolutely will look at tax credit.
Okay, I think we have to wrap it up now, and I've been told to tell you that the roundtables are going to be here. Around here.
The small round table.
The small round table. Okay, there we go. So thank you all, and we'll be around if you have more questions later.
Good to see you, Jason.
Good to see you.
Nice to see you, Jonathan.